Hey guys, welcome into today's video. And in this past week, the market had a bit of a pullback. As we can see, there's a lot of negative moves in playing these names. I got the heat map pulled up. A lot of this happened actually on Friday. You can see some big moves and even some of the large big tech companies, as well as the semiconductors and even some of the software names that have recently been catching a bit of a bid. So we can see like Nvidia down 6%, MU down 13, AMD down at 10%. If we move over to big tech, Amazon down 3%, Meta down 5.5%, which Meta's still been getting hit, and over the past year, has still just has not been able to catch anything, which I'm going to elaborate on that one more because that one actually is my largest holding. But Microsoft down another 2.6%, Google 0.98%, Tesla down 6.5%. We can see ServiceNow down 5.79%. CRM didn't get hit too bad, but still down 1.64%. So in this video, I just kind of want to go through a few of these names, look at them, look at the moves. Then I'm going to go through the moves I actually made during the week and what my plan is going forward. As you can probably see from the title of this video, I did have over $4,000 of buys. So I'm going to explain all of that going forward. So first off, we got to first keep in mind, so even though we did have a pullback, keep in mind this pullback, we're still higher than the lows we were beforehand, if that makes sense. Like if you look at a Zeta was probably the 14 range is where it was hitting its lows. Even with this pullback, we're still above the $20 range. We're still considerably above what it was beforehand. Even if you look at something like CRM, I think the lows, we were like, yeah, in that 160 range. We're still at 185. And then I think it's the same thing with Service now at a 112. It was just a few weeks ago whenever it was back in the 80 range. Yeah, the 90-80 range. So we're still considerably above. And for the reason for this pullback, at least what the market has been citing, is the jobs report that came in that was hotter than expected. Basically, there were more jobs in the period and lower unemployment that the market was expecting. So the market's viewing that as the economy is going to be hotter, potentially more inflation, and that means lower chances of a rate cut by the Fed, which is always just kind of a funny thing with the market because they're able to take all this news, and if they're feeling bullish, they're able to turn it and say, oh, this is a good thing, we're going to take the markets higher. If they're feeling bearish, they're able to turn around and say, no, this is actually a bad thing, we're going to pull it down. They're able to kind of flip it both ways because you think normally, oh, more Americans have jobs, that obviously be a good thing, but the market still finds a way to say, no, there's too many jobs, that's going to rack that up. And it's all a bunch of short-term stuff that you don't really have to worry too much about, especially if you're more on the long-term investing side. But with that being said, I do want to talk about one name. I was debating making a full dedicated video on this, but Meta is under 600 and Meta has not been able to catch a bid for quite a while. We can see year to date it's down 10%, past 6 months down 10%, even on a 1 year down 14%. And this is during a period, especially year to date, where some companies are doing really well, but it's really been a lot of those semiconductors. And a lot of this has obviously come on the back of the market not liking the capex spend of Meta. For a little bit of background for Meta, for me, this is my largest holding in my portfolio. It still remains the largest holding to this day. I bought a lot of my shares back in the 2022 crashes where I built the majority of my position, but I have bought a few shares after that, especially as this price has been pulling down. I bought in a little bit, but I've been kind of tame on how much I'm adding to it just because it is already a large part of my portfolio. So the main portfolio, I'm not adding too much. But what I will say is in my Roth IRA, I do actually also own Meta there, and I am actively buying month after month. But it's just a smaller amount of that because most of my Roth IRA I keep in index funds. But regardless of that, Meta has been pulling back here. And I think it's worth noting with this one that they are one of the few companies that is actually actively showing the benefits of AI. There was even an interview with with Jensen, where he was basically talking about how Meta's the best one at using AI, and we can even see it in the numbers. They accelerated their revenue growth to 30%, and honestly, I wouldn't be surprised if this starts to tick up more and more. So if you aren't aware, they started releasing more subscription services for their family of apps business. This is just another lever of monetization the company has, and the great thing about Meta, they have such a good differentiator between every other company. And the main thing, in one word I describe it, is their distribution. If I had to say one thing where I'm like, this is the reason Meta has like that competitive advantage, that moat, it's their distribution. They have half the world's population on their platform. Because of that, they're able to scale different revenue streams so quickly and so easily that they're able to just pull from all these different areas. It's like these different business lines are just able to pull and generate more money. We can see right now we've already had the acceleration of they're able to show more ads on their platforms, and they're able to charge a higher price per ad because there's more conversion. If you looked on Instagram recently, on a lot of these ads in the reels, whenever you're scrolling up on the comments, the first thing that pulls up is a web page for that product. And then under that, you can go to the comments, which is obviously going to increase conversion for any advertisers. And I wouldn't be surprised if to have that feature integrated like that, Meta is starting to take a cut from the revenue those companies generate, where in the past they haven't. They more of just charged for the actual ads. But maybe if they're actually buying through the Meta platform, using the browser in there in the little comment section, then they actually get a portion of that revenue. Maybe they can bake that in. That's another revenue driver. The subscriptions. Now with the subscriptions, the great thing is, like I said, they have half the world's population on their platform. Billions of people are on their platform. They don't need a lot of people to sign up for their subscriptions to go ahead and generate a lot of income. If we just actually go right here, let's go ahead and like run a quick back of the hand math calculation. So let's just say how many monthly active people are on Meta's family of apps, because I don't have the number off the top of my head from the last conference call. Monthly active people, about 3.98 billion. 3.98 billion people. So 3.98 billion, and we do that at a 2%. 3.98 billion. That's 79,600,000 people. I did the math on that right? Right? Yeah, okay. And then if we just say even their subscription, they're charging $5 a month, that'd be an additional $398 million of revenue. But likely, from what I've heard, some of these subscriptions are going up much higher than that, $15 to $18. I've even heard potentially a lot higher, like in the hundreds of dollars for business accounts, which of course businesses are going to use this, especially if small businesses are already using Meta to do the majority of their ads and run the majority of their ads. I think it would just make sense. If they're getting the return on it, they're going to spend on that. And that's the great thing with this company, and why I felt so much conviction making it my largest part of my portfolio and not feeling the need to cut any of it, even though it is such a large portion and a lot of my performance is tied up into this stock, is because when I look at this company, I look at something where they have so many different ways they can pull and generate more and more income. And I don't see realistically any companies competing with them in this space. And another thing that's not being factored in, and the market doesn't factor in, I know the Reality Labs is at this point what you'd consider a joke. Even so, when people don't, I'd say, put respect on it, I completely understand, because I'm kind of the same way. Because it's like, yeah, it's losing like $4 billion every single year. It's just losing billions and billions every single year. Yes, but I think the thing that's not being factored in is how much more monetization they can get as they build that out, with especially the actual Meta glasses. because I don't know about you, but I personally seen a lot more people having these, and the demand for those glasses have been insane. And that's just going to be another point of driving revenue for the company, not just in the actual hardware sales, but if they can add more subscriptions that tie in maybe with your meta glasses. And just they just have such a great way to just pull more and more income. The main thing is just being able to build out those other lines of revenue and those other revenue streams, being the subscriptions. I believe this is going to be a great tailwind. The company is not trading very expensive right now. Now, free cash flow is likely going to get hit, and earnings as well, from the depreciation expense. But if the company internally is seeing that they're getting enough of a return to justify that huge amount of capex, what was it guided towards? Around 130 billion was the last guide, around there. I think it just makes sense. Build out for it if they're seeing the return for it, which they clearly are. So I have no problem with the build out. It looks like they are putting in measures to re-accelerate the revenue growth. And if that revenue growth just continues to accelerate and accelerate, I think eventually the market's going to catch on and realize, oh, Meta's trading extremely cheap for what they're doing, which we've already saw that re-acceleration to around 30% on a base of revenue that's already as large as they have. And I don't think anybody's factoring in what if these subscriptions really do take off, and we're starting to talk about Meta coming up to growth rates of 35%, a 40% number. It sounds unheard of. It sounds crazy, especially for how much revenue they're already generating, but I would not count it out. I don't think it's a good idea to count them out on that. So for that reason, yeah, I'm not cutting any of my shares whatsoever. If anything, I'm still adding this in my retirement portfolio, and I'm just holding everything I have, and I'm going to let this continue to compound. So with that being said, for my buys for the week, first thing, that $4,000. So I had my $400 weekly deposit go in my account, obviously that goes in every week that I've described before. But I finally had to cut one of my positions. And this one, I cut 25 shares at about $170 is what I cut it at. And the main reason for this is I was just running my projections on a lot of these other names I had been building out positions into, mainly talking about Celsius, SoFi, even Zeta. I still think it's a good opportunity, but mainly I'm talking about SoFi, Celsius, ServiceNow, Salesforce. And when I was looking at it, I just thought it was a better risk reward at these prices. Excuse me. For this company, this was one that I bought back in 2020. For those who don't know, my average cost basis on it was about $7 a share. I've made well over 2,000%, and I didn't have a big base of cash that went in this stock whenever I first purchased it, because I was making a lot less money back then whenever I was investing in this in 2020. But because the stock appreciated so much, it's still a considerable amount of money that it grew to that is very helpful to just put into other positions in my portfolio. So even though the stock did run back up to 177, and I think it even touched 180 for a bit, yeah, back in the 180s, at the end of the day, that's not too big. I'm not too concerned about missing out and not timing the exact top of selling this out. My main thing was I was looking and I saw these other stocks that were just great opportunities, and I thought about it a bit over the weekend. I was like, you know what? I think it's time to finally just close my gains on this. It performed me well. I'm very happy with it, but let me shift it in over to other parts of my portfolio, and let me just spread out that money to other opportunities that I think I can get a higher return on. So now let's go ahead and get into what I was actually buying. So as you can see, 170.76 is what I had the shares taken at, and that gave me roughly $4,200. And with that, about 1,000 of it I put straight into SoFi. This was at $18.14. These are my buys on June 1st, which I believe was on Monday. Yep, straight on Monday. Celsius. about $1,000 into Celsius. In my past video, I had my actual projections and stuff for both of these, so you can go check those out if you'd like to see. But bottom line with Celsius, if it's under 25, I've been picking up fairly aggressively, especially that interview that Anthony Noto had on basis points with the mid. It really grew my conviction in the stock that I already had. And as long as I keep continuing to see that they're able to attract more and more members over the coming quarters at a rapid pace, I am perfectly fine with just continuing to build my position, as I believe the majority of that revenue generation and the actual earnings of the company is going to be very tied to the amount of members they're able to grow over the coming years. So as long as I see they're able to keep attracting more, I'm going to be 100% fine with that. No worries there. Same thing with Celsius. The CAGR on it from the projections I've been running is just amazing risk reward at these prices. I'm kind of shocked it's still around these prices, or that I'm getting it at these prices. And I just really like the product. Caffeine's very addicting. You don't have to really worry about any AI disruption fears with this either, because AI is not going to replace caffeine drinks. So continue getting that one and picking up that one. Zeta, I've talked about this one so much. How many videos have I made on this? Like 3. People are probably sick of me talking about this, but I still put almost $700 into Zeta as well, because this stock, I still just have conviction long term this stock is gonna be closer to 80. And honestly, with looking at my projections over and over, I honestly think my base case is not is too bearish. I honestly think my numbers are probably undershooting what they're actually going to perform, but I still want to remain conservative on that. But either way, on a 5-year timeline, I still see $80 very achievable for this company, which most of my shares were under 20. So we're talking about the majority of my shares being over 4x from here. But when I look at the company, the industry they operate in terms of the actual marketing and how well they're able to execute, this is one of those companies I look at. I'm like, I could see this being long term, like a $70-80 billion company, $100 billion market cap. I really could see that. And I'm not counting out that possibility. So for that reason, that's why I've been buying it so aggressively. And yeah, for anyone wondering, even though I'm up like I think 40%, I want to say, around like maybe 30-40% on the shares that I've been buying in the past couple of months that I've been buying heavy, I have no intention of selling those anytime soon. Like the stock could honestly run to 40, 35, 40, and I still would not let go of a single share, especially if the quarters keep coming in and they keep outperforming like they've been outperforming. One thing I've learned from being in the market longer and longer is if you have a company outperforming and executing, don't let that go. Let your winners compound is a main thing I could say. And just because the stock is starting to look expensive, if the company is still executing and you're holding shares at a low cost basis, it doesn't mean necessarily you need to close out your gains. Nobody ever went broke taking a profit. That's true. But also there is that opportunity cost, and you'd feel a lot happier, or you start kicking yourself if you took profits too early. That could be one of the worst feelings, because when you have that thesis of what's going to play out and you were correct on the thesis, but you sold out too early before the thesis fully played out because you think it ran too fast, that could be devastating. Think of the people in Palantir, maybe that bought in at 10 and they sold at 50, and then it subsequently ran up to 200, or even now it's still in the 130, 140 range. That sucks. That sucks to sell out that early, especially if you were someone who had conviction in the stock and you already knew the actual thesis behind why it's going to go to this valuation or why it's going to continue accelerating its revenue growth, and you still sell out. You did the hard part of building your thesis. Just let it play out. Let it play out through the ups and downs. It's all right. But that's more just talk. That's more just something talking to myself on that. just because I do have a lot of conviction in this one. Now, Salesforce, $700 worth at $200. So Salesforce has been running quite a bit, as has ServiceNow. I got about 4 shares of ServiceNow, $550 just about at 137. So unfortunately, I got that pretty high because the stock did pull back. And then on June 2nd, I went in and had some more by the deposited my other 400. So with that, I had Celsius, about another $120 of Celsius. We'll speed run the rest of these. ServiceNow, about another $75 at 125. Salesforce, I bought another 75 at 196. Zeta, I got another about $50 at 24. SoFi, about another $90 at just about $18. And finally, again, I got another share of Celsius about at around $29. And finally, a share of SoFi, $17.05. Now, one of the things I am happy about before I go ahead and end this video is I'm actually glad about this pullback, because for anybody who remembers the video where I was first announcing that I was going to start looking into adding a position in ServiceNow and CRM, one thing is I was getting worried they were going to run up, which they looked like they were starting to run up too fast. Because on my base case, I believe I had a target around 135 is what I was looking at for ServiceNow, where I wanted to try and buy it under that range. Let's see. Yeah, I was trying to get shares under 125, which I did buy a little higher for this week. Under my base case, I still had a fair value around the 158 to 182, but ideally I like to have an extra margin of safety in case I made a mistake on some of these projections. So I was trying to get it under 125. So now that it's pulled back, we'll see if that holds, but if it does, that'll be good for me to be able to add. And then same thing for Salesforce. I'm trying to continue adding positions under 215, which it pulled down considerably from there. So that is helpful as well. So I am actually fine with that. And then as well as Celsius, I believe it was kind of the same thing with Celsius where, let's see, Celsius, what did it close at? There it is. 28.13 for Celsius. So well under what I was trying to get Celsius at, and 112. So ServiceNow pulled back pretty considerably. And then I guess I can show my Celsius over here. I'm trying to buy under 42. So I still have a pretty big margin of safety on my Celsius shares, but obviously if I can get them cheaper, then I will not be mad at that. But anyways, that's going to be the video today. Those are the moves I made during the week. And let me know if y'all be interested in a more dedicated meta video, because that was one I was thinking about making. Kind of just going more in depth on my thoughts on all those different revenue streams and the potential for it. I just haven't put that together, but if enough people are interested in that, given that it is my largest position, I would not mind doing that. Thanks for watching.